Listen, 6-month chart of Celsius. The stock has gone up 166% in 6 months. I mean, it feels like 6 months goes by in a snap of fingers. It's like, oh my gosh, right? And 166%, that's ridiculous. When you consider, right, it's done that in 6 months. If you're in an index fund, you would hope to make 167% over probably 10 or 15 years in an index fund. And Celsius is giving you that return in 6 months? That's insane, right? So the question you have to ask yourself, okay, a stock like this just gave you 10 to 15 years worth of index fund gains in a 6-month span. What changed with the business? Like, what? There must have been something fundamentally really changed in a massive way for this company, right? Well, if I take you back to 6 months ago, what happened? 6 months ago with Celsius, there was a lot of growth concerns from Wall Street and from investors. They were scared about revenue growth of this company. There was also margin concerns and where the margins of Celsius were headed. Additionally, there were market share concerns. How much market share is Celsius going to be able to get of the energy drink category or not? Additionally, there was Pepsi deal concerns as well. From when they did the Pepsi deal, Pepsi ordered way too much inventory. They boosted the numbers way up, way too high in 2023. So it was all those questions about that, okay? And then additionally, there was energy drink category concerns as well, because we saw some negative data in regards to the energy drink category. So it was like you just had an onslaught of all these things going like negative against Celsius in regards to people viewing the stock, right? What have we had since then? What has cleared up in the past 6 months that also makes everybody want to go buy the stock and say, I wasn't willing to pay $20-something for it 6 months ago, but you know what? I'm willing to pay $60+ for it now 6 months later, right? Well, we no longer have category fear. Now people are confident again in the energy drink category in general. They're confident that the compounded annual growth rates of the energy drink category is going to be very strong. And that's a fundamental change in regards to that. So that fear, it's gone now at this point in time. Next fear was around revenue growth. There's no fear there anymore. Celsius just reported $739 million of revenue. That compares to $401 million of revenue in the same quarter last year, which, if my math serves me correctly, that's like 80% plus growth for Celsius here. So there's no longer fear about, can Celsius grow the top line? No. That's gone now at this point in time, okay? Additionally, if you talk about market share and where Celsius's market share is, there's no longer fear around that. You know why? Because in their latest quarter, they just went to a 17.3% share of the U.S. energy drink category, up 180 basis points versus a year ago, led by demand for zero sugar and functional beverages. And my guess is, where's this market share number going for Celsius now that they have the Alani brand as well? My opinion is, the market share for Celsius is going to 20+% long term. That's my opinion. They will be a 20% plus market share in the United States when it comes to energy drink category. And remember, international, and basically almost every important international market you would look at for the energy drink category, they're like single digit percentage. Like they're like a baby international right now. And believe me, based upon my opinion on studying this energy drink category for a long time, I used to be an investor of Monster Energy a long time ago, and even recently as well. I don't have any shares in Monster right now, but I know this energy drink category very well from my days at Walgreens, my days at Quick Trip and management. I know this category very well. In my opinion, international, they will be going to double-digit share international as well, and that's where you're going to see the biggest revenue growth opportunity. 2026, 2027, 2028, 2029, 2030 will actually be international. It's the same thing that happened with Monster. Monster grew massive market share in the United States, and then it was all about growing huge in Europe. Then it was about growing outside of Europe, in Asia, in Latin America, everything like that, right? That's a game Celsius will be playing for the next 10 plus years, okay? Now, additionally, margin fears. There's no margin fears around Celsius anymore at this point in time either. Because you think about this last quarter, all the tariff drama, what's going to happen with aluminum pricing, blah, blah, blah. And Celsius still came through with extremely strong gross margin of 51.5% despite all the drama, right? And, this was the first full quarter really of Alani being in there. And so you usually have some hits to margin that are usually negative whenever you have a new brand, that comes into your space as well. And you have to, obviously distribute that product and do things differently. It's usually some some one-off hits, things like that to your margins, and Celsius just motored right through, right? Now, additionally, Pepsi, they made that major investment into Celsius, several years now ago at this point in time. 2023, they went too crazy with the ordering and into the first part of 2024, and then there was a come down of that, and it was dramatic, and it hurt Celsius's growth numbers. It made Celsius look like it was no longer a growth company when it is in reality, right? They're no longer being held back by that. Celsius is, from my understanding, Pepsi's cleared all the inventory, so that's not even an issue anymore at this point in time. So the Pepsi problem this stock had second half of, really a lot of 2024 and into maybe the very beginning of this year, that's old news now at this point in time. That's no longer an issue for the company, right? Now, in regards to stock price and where the stock price of Celsius is headed from here, okay, listen. If you think about where the stock was, we can call it back at the beginning of 2024. This was a stock that was getting close to $100. It was pushing, $96 or so, right? Think about the company now versus then. This is a way, way more exciting, better business model, in my opinion, with not only the Celsius brand, but the Alani brand as well. The market share they now have, the penetration now they have, the ability to grow Celsius internationally, and Alani in the US and internationally. Like, this is a way better, in my opinion, safer company now than it was back when that stock was hitting 90 plus. So in my opinion, that stock's headed to 100 plus either this year or next year, in my opinion. And, not every day is going to be up, not every week's going to be up, but the trajectory will be up and to the right, in my opinion, in regards to Celsius, because the numbers are just going to keep coming through, in my opinion, stronger, stronger, stronger. And do you know what's going to happen? I'll tell you exactly what's going to happen. Every single person that wants exposure to growth in the drink category is going to want a piece of Celsius, and they will buy the stock, and they will buy the stock. And until Celsius comes down to, let's call it single digit growth rates in regards to them, like, the stock will continue to find buyers. And the holders, like, what's our incentive to sell? This is something important you guys got to understand, okay? Listen, before we get into SoFi, ELF, Meta, hedging, all those sorts of things, listen, where's my incentive to sell my Celsius shares in the public count? I think it's up to my fourth biggest position in the public count. I think I have, 4,000 shares of Celsius in there. Where's my incentive to sell Celsius right now? We're at a company that's still so early days in the international expansion. They're still growing rapidly in the United States. They got the Alani brand, one of the fastest growing, if not the fastest growing brand out there of major brands in the energy drink category. The margins look great at 50% plus. The profitability should skyrocket in 26, 27. They got the Pepsi, hookup there, right? So Pepsi's very incentivized to do everything they can to make sure Celsius and Alani are successful over the next 5, 10, 15 years. Where's my incentive to sell Celsius? I just don't have one. And so that means you're going to have stubborn longs who aren't really interested in selling, and you're going to constantly have people flooding in to buy this stock, because it's, where else are you going to find these sorts of growth rates in the drink category, period? You're going to look at Coke, Pepsi, Keurig, Dr. Pepper. Those growth rates are like, those businesses had trouble even growing at all, right? Monster growth rates have obviously come down immensely over the past 10, 15 years. So you're not, like, Monster's not some major growth name nowadays, right? That's just kind of like a stable, good, growing company. Celsius is the one that you look at and you're like, that's the growth beast. And so that's going to continue to attract that money that wants to go into a growth name, right? How would you like access to all my best course curriculums? My Becoming Master of the Stock Market course, my Stock Market Investing Mastery course, my Stock Options Mastery course, my Millionaire Playbook? How would you like access to all my best courses, as well as the ability to have access to my 6 and 7 figure plus Discord community, where we're constantly keeping in touch with each other, talking about what's going on in the market? How would you like exclusive weekly videos from me? How would you like the ability to see what stocks I'm buying and selling in my $2 million plus Fidelity account? If that all sounds pretty interesting to you, apply to join my private group. That is going to be linked in the description area down there. You can click on that, fill out an application, and go ahead, hop on a call with Andre. Andre will walk you through the whole process. He'll walk you through the whole group, and you can go ahead and join us in there. Once again, the link for that is in the description area. Howard Marks on early days of a bubble in the market.
That you pose yourself. Why are asset prices so strong in the face of what you view as net negative?
Oh, by the way, Howard Marks, he's got a great book. I keep it beside my bed actually on Mastering the Market Cycle. Very, very good book. If you're ever, looking to read that, there's a lot of important lessons in there and understanding the market dynamics and the cycles that the market goes through.
Howard, can you share your thoughts with us?
I'm glad to be with you this morning. Of course, as the quote you just put up on the screen indicates, this is all just feeling and an opinion. None of this is factual, but it does seem that stocks are expensive relative to what I call fundamentals, or you might call reality. And the outstanding reason, I think, is that there hasn't been a serious market correction in 16 years. So people get out of the habit of thinking about market corrections.
It's just not accurate, Howard Marks. In all due respect, that's just not accurate. Listen, from the peak in 2021 to the trough in 2022, the NASDAQ fell over 37%. And that was over about a year time frame. Okay, from the peak in Q4 2021 to the trough in Q4 2022, NASDAQ fell like 37%. If that's not a severe major correction, what is? What is? That is extremely severe. Okay, the S&P 500 over that time, I believe it fell 25% or so. That's very serious, and that was over about a year's time frame, right? Because the market kind of peaked like November 21 and then troughed around October 22. That's serious stuff, okay? Is it as bad as it was in the Great Financial Crisis when the NASDAQ fell over 50%? No, not that bad. But 37% is no small amount, okay? You talked about many of the best, most well-run, most profitable tech companies in the world. Some of those stocks fell 30, 40%. Others fell 50, 60, 70, 80%. So, like, this notion of, like, we haven't had anything crazy since the great... No, we have, right? Now, the Rona crash, where the market went down 30+%, that was a rather quick one, right? That was really sharp down and really sharp up. That was extreme V. So I can understand if people kind of disrespect that crash, right? Don't take it that serious. What we had in April, when the market fell around 20% or so, very quickly, I can understand if people don't take that serious because that was a very sharp V-shaped recovery. 2018, we had some nastiness at the end of the year where the market fell 20+% from where it peaked at in September of 2018 to where it troughed at in, right before Christmas that particular year. That was pretty serious. Is that a great financial crisis? No, but like that was pretty serious. But also, everybody thinks like the great financial crisis is something that just happens all the time. It doesn't always happen. Like the whole banking system nearly collapsing. Do you know how rare that is? I don't think people like Howard Marks is extremely educated on the market, but yet has this like notion of like not understanding like base premises of like that's not normal. That almost never happens. We've almost lost the banking system 2 times in history. Okay, since the kind of, you could look at modern day banking system, right? The last 150, 200 years. We almost lost it twice. Howard Marks knows this. Once was in the Great Depression, right? And the other was a great financial crisis. And that's it. So that's an event that might happen once every 80 to 100 years. And the stock market crashed over 50%. Peak to trough. Severe. But if you're expecting like, the whole banking system to collapse again, it might someday. 50 years from now, 60 years from now, 70 years from now. Like that doesn't just like happen all the time. Like, every 10 years the banking system collapses. No. That, someday that might happen again. A long time from now. I might be a man with full of hair like that when that happens again. It will happen again, right? But it doesn't happen very often.
The biggest single mistake, I've been thinking a lot, what is the biggest single mistake investors make? And I've concluded that it is that they conclude that the way things are today is the way it'll always be, and the things that have been happening will always continue to happen.
Yep.
Whereas reversion to the mean is much more likely. So I just think that it's worked very well being an equity investor has worked very well. Doing it on leverage has worked even better. Concentrating in a few stocks has gone very well. Investor.
I don't know. I disagree with him again. He just said doing it on leverage has worked out very well. Disagree, Howard Marks. Listen, if you were on leverage early this year, you could have got stopped out of the market. With how dramatic that drop was in March and April from where we peaked at around February 19th to where we troughed at around April 9th, oh my gosh. Like, stocks were getting obliterated. If you were on margin at that particular time, you got wrecked. If you were on margin going into 2022, you got beyond wrecked. Because let's be honest, the people that do margin are the same type of people that would buy NVIDIA stock or Netflix stock or Shopify. Those stocks fell like 80%. Right? Like NVIDIA fell like 50% peak to trough. Netflix fell like 70, 75%. Shopify fell like 80%. Like, that's the same type of people would buy those sorts of stocks. Small cap stocks got absolutely obliterated. So I disagree. Like, that's just not true. Like, you've been on margin, you could have got wrecked. You were on margin going into the 2020 crash. Oh my gosh. You might have lost your whole portfolio. So, no, it has not been a great time to be on margin anytime in the past few years with how you get these dramatic crashes. Because during that, you get those margin calls. And next thing you know, you lose half your portfolio. Like, half of it's gone. And then the upside comes, and then you're not even on margin anymore because you got margin called. And you're like, oh, great, I lost half my portfolio, had to be forced to sell. And now you can't participate on the other side the way you want to.
By nature optimistic, and that optimism dies hard, I just think that the fluctuations of the market are mostly related to psychological fluctuations, and people go from neutrality to liking stocks, to liking them a lot, to liking them a ton, to liking them too much, and that's the continuation that creates bubbles, and we probably in the early days of that.
When you talk about liking, Howard, maybe liking these assets a little bit too much, can you put into perspective the last time you saw this type of environment that left you thinking maybe some of the opportunities aren't as great when it comes to buying some of these assets at current valuations? Is there...
Now, Howard Marks' point in regards to valuation with stocks, completely fair. I don't care what you look at, price to book. For the overall S&P 500, you can look at trailing 12-month P, forward P. They're all extremely rich, right? That's fair. That's an easy one to point out there. The other part I'll push back here is around the psychology of the market. Because what is the main thing you've seen continuously this entire year? Okay? I want you to look at something very important. It's called the AAII investor sentiment. Overwhelmingly bearish the past 6-7 months. Overwhelmingly bearish. Far superior to, really any time period you look at since that survey has been done in the 1980s. Like, if you look at how bearish investors are on the market the next 6 months, and you look at the data for the last 7-8 months now at this point in time, it's been overwhelmingly bearish. You can look back all the way back to the 1980s. I think you'll have a hard time finding any time period that was this bearish for 7 months. Incredibly bearish. And so, it's not like there's like this euphoria feeling like, oh, investors are like only bullish on the market the next 6 months. The data shows they've been bearish and bearish and bearish and bearish. And yet, despite that, we've hit all-time highs.
Time that this sort of reminds you of in any capacity?
Well, I guess, Lisa, the last time was probably around 97, when the market was kind of falling in love with tech stocks, and the market was rocketing along. People were not worried about the level of valuations. People were extremely optimistic about the opportunities for the internet, Alan Greenspan famously cautioned that there might be irrational exuberance. Now I picked 97 because even though Greenspan was concerned about exuberance, the market went on to rise for another 2.5 to 3 years. So remember, I said we're in the early days. We're not we're not at a nutty valuation. I'm certainly not ringing the alarm bells, as the quote that you had on the screen said. No reason to think there'll be a correction soon. But the point is that things are expensive. They may go on to become more expensive, but the fact that they're expensive, it should not be lost.
And Howard, I think a lot of people point to, in terms of the echoes of the late 90s, the tech sector of the market as being the most overvalued. What I thought was so interesting about your memo is that wasn't your take, that wasn't your bigger concern in the market at a time when people are counting on a certain robustness of growth and a certain kind of inflationary backdrop. Why is it that tech isn't the focus of your concern this time around?
Tech contributes to the aura that surrounds the markets. And a lot of people have been citing the fact that the so-called Magnificent Seven, stocks like Amazon and Alphabet, have been contributing disproportionately to the rise. And they're responsible for more than 7 stocks. Their dollar gains have been responsible for more than half of all the gains in the 500 stocks in the S&P, 7 out of 500. But they're great companies. They're at high valuations. I think that I can't say those valuations are excessive. But the other 493 stocks are quite highly valued, not as highly as the Magnificent Seven, but nobody says they're the same quality company, quite highly valued relative to history. And it is the fact that high valuations are being applied to more average companies that I think's more alarming than the fact that exceptional valuations are being applied to exceptional companies.
Howard, there's a quote you use in this memo. I enjoyed this quote. You said, "He who knows only his own side of the case, knows little of that." And then I worked through the rest of the memo, and there was a conclusion there about credit. And I just wonder, sir, whether your focus on equities in this note offers you a greater perspective on how much value is offered in credit right now.
Well, it's as John Stuart Mill said in, I believe it was 1859. You have to know all the sides of the story to understand whether your side holds water. And I cite the bull case there for why the market isn't overvalued. I think that's...
Okay, so what do you do? What do you do in a situation like this, right? You got Howard Marks saying, I'm worried about valuations, which is a completely fair point, but, the market could go up for another 2-3 years, right? Like what happened with Alan Greenspan, the irrational exuberance, all those sorts of things. What do you do as an individual investor? And you're looking and you're like, dang, maybe the market's rich, but maybe some stocks are really overvalued and some stocks are actually undervalued here. Here's what you do. You focus on what you can control. What you can control is making sure you got more income than expenses, investing on a steady basis every month, every few weeks, finding great opportunities in the market. There's plenty of opportunities in the market on significantly undervalued stocks that are going to do tremendous in the next 5-10 years, regardless if the market crashes in the next few years, has a correction in the next few years, because guess what? Corrections happen in the market, and you got to invest right through those. You invest before the correction, you invest during the correction, you invest coming out of the correction, the crash, whatever it is. And that's fine. Like, those get over. Like, a small correction might last a month or two. A major, severe correction might last 3 to 6 months, right? And a crash lasts usually 1 to 2 years. Big deal. And you just buy right through that the whole time. So, you can wait it out and hope you can time it out perfect, but it's a losing game. We know that. It's always a losing game. You've got to invest right through it. You've got to find those opportunities that are phenomenal. And if they get cheaper because the market goes through a correction or crash, great. You get to buy those stocks for even cheaper, right? AMD, you could have started buying it before the severe correction we had in April, right? And you could have started buying AMD at, 110. And at the bottom, AMD went into the 70s, right? So you could have bought at 100, at 90, at 80, and, at the very bottom when it bottomed at the 70s. ELF is a great example. Could have been buying that before the severe correction in the 90s, and then ELF went all the way down to, I think it was $50 at the lows, right, or $49. You bought some more. As long as you got a little more income than expenses every month or every 2 weeks, right? You're always ready to buy, 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 buy. And you could have been buying ELF as it went down from 100. Say you start your position at 100, you bought more at 90, you bought more at 80, you bought more at 70, you bought more at 60, you bought more at 50, then it starts going up again. You buy more at 50, you buy more at 60, more at 70, more at 80, more at 90, more at 100, right? Then you pull back your buys. Now you just loaded up on ELF. You probably got a cost basis of $70 or so. And the stock today is what? 115, 120, somewhere around there. You've already made crazy profits. And that's in a short amount of time. You're probably, if you're a long-term investor, you're thinking about ELF for the next 3-5 years. And you're already sitting pretty. And that's despite you starting to buy before the major correction came. That's how you play this game on a higher level, man. You focus on what you can control. I can't control if the market has a correction tomorrow, next week, next month, next year, or crash or whatever. Like, that just is what it is. That's just part of the game. We buy. We buy great assets. We hold those great assets. We let them appreciate over time and make us a lot of money.